Hi everyone. I'm going to go over exercise 12.8. 12.8 similar to the last two we went through. But just to kind of break this down, this Professional Products Inc., a wholesaler of office products, was organized on February 5th. That's kind of when they started of the current year. The state they incorporated, they asked to be authorized to issue 50,000 shares of preferred stock, 2% at $40 par value. So first of all, authorized means they went to the state, incorporated, and they said they wanted to be able to sell or issue 50,000 shares of preferred stock. So that's what that means. The 2% means it's going to give a 2% dividend of $40 every year. We're not going to do that in this class, but that's just so you know what that means. And at the same time, they were also authorized to issue 1 million shares of $8 par value common stock. On February 5th, they issued 600,000 shares of common stock at par value. So they sold them for $8 a piece, 600,000. On that same day, they got a lawyer to help them incorporate, but instead of paying them, right, to help for organizational costs, instead of paying them, what they gave the lawyer was 1,500 shares, which he or she accepted, and the value was $8. On April 9th, they gave up shares, issued 45,000 shares of common stock. What they got was land, building, and equipment, and they gave you the fair value of the land of 100 grand, the building of 310, and the equipment of 85,000. And then lastly, on June 14th, they issued 30,000 shares of preferred stock at $53. So we're going to take that information, and they want us to do journal entries. Again, to go over this, it's going to be similar to what we did before. This first one, you could see they used the 600,000 shares times the par value. There was no additional paid in excess because they issued them for the par value, meaning they sold them for $8. So 600,000 times 8 comes out to 4.8 million, and that's your debit to cash and your credit to common stock. Why there's no paid in capital excess is because they issued them again for the par value. On that same day, they got a lawyer to do work for them. Instead of paying them, they gave them stock. We call that organizational expense. Sometimes you could call it legal expense too, but this book calls it organizational expense. They gave the lawyer 1,500 shares. He or she accepted it, and the par value was 8. So 8 times 1,500 gives you 12,000. They're debiting an expense account, and then they're crediting common stock. So in other words, instead of paying the lawyer for their service, he or she just accepted stock in place of it. So that's why we're not crediting cash. On April 9th, again, they got land worth 100,000, buildings 310, and equipment. So they got all this, and what they gave up is common stock. All right. The common stock is always going to be credited for the amount of shares you give up times the par value, so that's where the 360 comes from. You could then just add these three together, will come out to 495, and subtract the 360, and that's what the paid in capital in excess would be. But to explain the way they did it, to kind of show you where this 11 comes from, I'm going to kind of show you that in this next thing right here. If you take the cost of the land, the building, and the equipment, that equals 495. The 45,000 shares is what they gave up, so that comes down to $11 per share. It's kind of like they sold it for $11 per share, because what they got was $495,000 for the stuff, and they gave up 45,000 shares, so it breaks down to $11 per share. Why I did that, again, is to try to demonstrate to you where this $11 comes from. That's where they got the 11. The 11 minus the 8, which is the par value, comes out to $3 a share. 3 times the 45,000 also gives you that 135. But again, an easier way would be just to add up these three, 495, subtract 360, which would give you 135. That would have to go into paid in capital in excess of par because that's the amount up and above the par value. And the last one's kind of straightforward. The cash they got in was 30,000 shares. This is the preferred stock times $53, what they sold it for. So they got 1,590,000 in. The preferred stock always has to be credited for the amount of the shares you gave up times the par value, which is 1.2 million. That difference between these two is 390. Or again, you could take what they sold it for, 53, minus $40, which is the par value, comes out to $13 per share times the 30,000, and you would also get the 390. So again, in this, company's trying to either get cash in, get some legal fees, or get some land, or cash in the end, and all those, what's happening is cash or assets are going up. Only this one has an expense goes up, so there's a debit. Notice the credit to common stock is always at the par value. Only in the case of April 9th was there's an excess, so that's why we use this paid in capital excess. And then the last one we used it because we sold the preferred stock above the par value. Again, I hope this helps, and I'll talk to you soon.